Welcome back to our weekly market update. So this is shaping up to be one of the most important weeks of the summer for markets, with both the Federal Reserve meeting and a wave of earnings reports from some of the largest companies in the world. Let's start with the Fed. While inflation concerns have picked up again recently, a rate hike this week still looks unlikely. One reason is that geopolitical tensions in the Middle East eased over the weekend. They helped oil prices fall nearly 15% from last week's highs. That takes a little pressure off the inflation outlook, at least for now. We'll see where we go from here. That said, the conversation around higher rates is not going away. The economy continues to show surprising resilience. Initial jobless claims recently fell to their lowest level since 1969. Economic data has consistently come in better than expected. Stock prices remain near highs, and credit markets continue to function well. So, put simply, there's just not much evidence that today's interest rates are significantly slowing the economy. And so the Fed has room to raise rates if needed. The other major focus this week is earnings season. About 175 S&P 500 companies will report results over the next several days, including Microsoft, Meta, and Amazon. Investors will be paying especially close attention to AI spending. These companies have invested heavily over the past couple of years, and so now the market wants to see those investments translate into stronger profits. With about 30% of companies reporting through last week, the second quarter earnings season has so far been very encouraging. Second quarter earnings growth is currently tracking around 38% year over year. Now, Alphabet, formerly known as Google, deserves a lot of the credit for that after reporting a very large gain in the other income category last week. This is where the company's investments in companies like Anthropic and SpaceX generated earnings of nearly $100 billion during the quarter. Those investment gains aren't necessarily recurring and they can be quite volatile, so it's always worth digging into the headlines a little bit. Now, if you exclude Alphabet, though, S&P 500 earnings would still be growing at roughly 26% year over year. And that would mark a second consecutive quarter of better than 20% earnings growth and the seventh straight quarter of double-digit earnings growth. So in other words, corporate America continues to deliver healthy profit growth. What's interesting is that the market's reaction has been much less enthusiastic. Companies that are beating earnings expectations this quarter have actually seen their stocks fall slightly on average, while companies missing expectations are being punished even more than usual. Now, that's often a sign that investor expectations have become very high, and good news isn't always enough when optimism is already priced in. And that's one of the reasons we're continuing to emphasize diversification. The economic backdrop remains constructive, but we also see several risks that are worth paying attention to. Interest rates could stay higher for longer. Treasury yields have continued to move higher, with the 10-year Treasury around 4.7% and the 30-year Treasury above 5%, and actually near its highest level in close to 2 decades. We still have geopolitical uncertainty in the Middle East, and we're less than 100 days away from the midterm elections, which could introduce additional volatility. None of those developments change our long-term investment philosophy, but they do reinforce why we are maintaining a balanced approach rather than making aggressive bets in either direction. As always, we'll continue monitoring these developments closely and keep you updated as the data comes in. Thanks so much for watching. Have a great week. And if you have any other questions, please don't hesitate to reach out to your advisor. We'll see you soon.